Hey guys, got a good one for you today. Let's say you want to buy 100 shares of PepsiCo. Right now it's trading at $170 a share, which is fair price, but you'd like to buy it for $160 a share. Well, you can't right now, so you got a couple of options. You could sit around and watch it every day and hope that it dips down to $160, or you could get somebody to pay you $200 in cash right now for agreeing to buy it at 160 if it happens to fall that far in the next month. If it doesn't fall that far, you keep the $200 and you're free to do it again. That's the whole strategy that I'm talking about in one sentence, and it's called selling a cash secured put. Here's why this works especially well on stocks like PepsiCo instead of other hyped up momentum stocks. Options trading gets a bad reputation because people sell puts on volatile stock that can drop 50% overnight. And when that happens, they're forced to buy something that just fell off a cliff. PepsiCo isn't that. It's raised its dividend every year for over 50 straight years, which puts it in a small club of companies called Dividend Aristocrats. If you get assigned the shares, your worst case isn't getting wiped out. It's owning a proven dividend-paying business at a price you already decided was a good deal. And the moment those shares land in your account, the dividend checks start. So, how does the process actually work? When you sell a put, you're acting like an insurance company. Someone else is buying protection from you, and you're the one collecting the premium for taking on the risk. One options contract always covers 100 shares. To make the trade cash secured, your broker requires you to hold enough cash to actually buy those shares if you're assigned. So if your target price on PepsiCo is $160, you need $16,000 sitting in your account as collateral. In exchange for tying up that cash, the buyer pays you a premium up front, and you pick an expiration date, usually 30 to 45 days out. At that expiration, one of two things happens. Either PepsiCo stays above 160 and the option expires worthless, in which case you keep 100% of the premium and your $16,000 is freed up for you to do it again, or PepsiCo drops below 160 and you're obligated to buy 100 shares at that price. But because you already pocketed the premium, your real cost basis is lower than 160. If you had collected $200 in premium, your new cost basis would be $158 per share. Now here's the detail almost nobody talks about, and it's the one thing that separates people who do this well from people who just get lucky. Never sell a cash secured put on a big green day. Options prices are driven heavily by something called implied volatility, which is basically the market's estimate of how much a stock is about to move. When a stock is ripping higher, implied volatility drops, and that means the premium you collect shrinks along with it. You end up getting paid less for taking on the exact same risk. Instead, you want to sell on a red day. Wait for the stock to pull back 1.5% to 2% or more in a single session. When a stock drops, the fear spikes, implied volatility spikes with it, and option premiums get inflated. On a green day, PepsiCo at 175 might only pay you $150 for a put at a 30 delta strike. On a red day with the same stock down 2% to $171.50, that same strike could pay you $220 instead. Same risk, same stock, 47% more cash just because you waited for the right day to sell. Let's actually run the numbers on a real setup so this isn't abstract. PepsiCo is trading around 170 after a red session. You pull up the options chain and pick an expiration 30 to 45 days out because that window is where time decay, also called theta, works fastest in your favor as a seller. Instead of guessing at a strike, you look for one with a delta between 15 and 20. Delta roughly tells you the odds the option finishes in the money. So a 20 delta strike means there's roughly an 80% chance the option expires worthless and you keep the entire premium. That points you to the 160 strike. Your collateral requirement is 160 times 100 shares or $16,000 in cash held aside. The premium on that strike comes in at $2 per share or $200 total. Your break even if you do get assigned, is 160 minus that $2 or $158 a share. Even in the worst realistic case here, you're buying a Dividend Aristocrat almost 7% below where it's trading today. On the $200 you collected against $16,000 in tied up cash, that's a 1.25% return for roughly 30 days, which annualizes out to somewhere around 15% on your cash if you can repeat it consistently. Before you go place this trade yourself, there are 3 things worth looking at. First, check the earnings date and the ex-dividend date before you sell. Volatility spikes around earnings, and a falling stock price heading into an ex-dividend date can occasionally trigger early assignment, so you want those dates on your radar so you don't get surprised. Second, you don't have to hold every put to expiration. If the options value drops 50 to 70% within the first couple of weeks, that's usually a sign to buy it back early, lock in the win, and free up your $16,000 for the next trade instead of squeezing out the last few dollars of premium. Third, and this is the one people forget when the strategy is working, if the stock crashes well past your strike, you're still buying at that strike, and your paper loss is real relative to where the stock is trading. That's exactly why this only makes sense on a business you'd actually want to own for years, not something you picked because the premium looked juicy. If you're weighing this against just buying PepsiCo outright at $170 today, here's the deal. Selling the put isn't a way to avoid ever paying full price. It's a way to get paid for the privilege of waiting for a better one on a stock built to survive that wait. If PepsiCo never drops to 160, you've still made 15% annualized on cash that was otherwise sitting idle. If it does drop, you own it cheaper than anyone who bought it today, and you start collecting dividends from day one. And if you do end up assigning those 100 shares, that's not the end of the strategy. It's the halfway point. Selling covered calls on top of the shares you were just assigned turns this into a 2-sided income engine instead of a one-time trade. Thanks for watching. If this was useful, drop a like and subscribe for more videos like this one. Happy trading!